Hello and welcome to episode 416 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leakes. Damien, welcome back. How are we doing?
Well, good. It's good to be back. I mentioned on last week's show that I was going to my old stomping ground. I went to Warwick University and, well, that was quite depressing. I mean, it was great. It was great to see the campus, but obviously things have changed a lot in the 25 years since I've been there. And while I was walking around, it was a point where I decided to stop doing this to myself when I came across what used to be a field that linked between two parts of the campus. There was now a forest there. They've grown an entire forest in the time between me leaving and today. So, yeah, that was quite depressing, but I did enjoy it. So I've had a good week. I just want to throw something else, completely changing the subject, AI. So a couple of weeks ago, I did a piece on the podcast talking about how to invest in AI, and go and look at Nvidia, which is a company that I mentioned in that particular podcast episode and in the research that I did for 80/20 investor members. And Nvidia make chips, so chips that will be used in the processing power to be able to enable AI. And they released some results this week, and given that they are a huge tech company, their share price jumped 23% in overnight trading. So therefore, today, pre-market, they were due to go up, their share price up 23-4%, which is incredible. Now, to give you context, there have been people out there who are saying they've never seen something like that in the 40-odd years that they've been investing, stuff like multi-decade. And yes, you see it in penny stocks, small companies, but a large mega cap company, huge company, for its share price to jump that much. It was just illustrating the point about AI, the trends that are happening, but also one of the companies that I highlighted in that piece. Interesting to see it actually play out in reality. And maybe there were some people who made some good money on that.
Very interesting indeed. Okay, so let's get on to what we've got coming up in this week's show. What have we got? What are the three main pieces?
So, gold. We've not done gold for a long time on the podcast. I thought we had. I mention it occasionally in my market updates that I do, but really when I look back, we haven't done it for years. So I want to do a piece on investing in gold, and it's more about the outlook for gold, but also how much you should hold in a portfolio. It's all based off of some research that I'm doing for 80/20 investor members, which will be coming out shortly. We're then going to go on and do a piece about interest-only mortgages. Now, there are a lot of people who are on interest-only mortgages. They may have been on them for a very long time since the financial crisis because, of course, interest-only mortgages now are a bit of a rarity, and they are worried about how they're going to repay that mortgage at the end of the term. And there's a lot of people, I think when I saw numbers, about 1 million people who are going to be in that boat having sleepless nights. And I want to do a piece about what their options are, so giving them a bit of light at the end of a tunnel. And the final piece, Andy, you're going to be doing...
I'm going to be doing on the energy price cap. The latest figures have been announced this week. So I'm going to crunch the numbers and explain what it actually means for people. Are bills going down? What is the energy price guarantee? What is the energy price cap? How the two figures kind of marry up. And so we'll do that at the end of the show. Just a quick roundup so people know exactly what's happening.
Yeah, and what's important on that is that people see the headlines but don't know how it relates to their energy bill. So that's why we're doing it on the show. We have done some stuff on energy recently, but this is quite a big story because we should be able to tell you what your energy bill is likely to be versus what you paid in the winter. That's all we really care about, if we're being honest.
That's it. We're going to make it super simple for people. So let's get on with the first piece of the podcast then. We're going to be covering gold. Haven't done it in ages. What have we got?
So gold, investing in gold has been something that's come to the fore. People have been writing in about it because the gold price has rallied strongly. So if we look at the price at the moment for an ounce of gold is $1,950, around about that line, and it recently broke above the $2,000 mark. And what we've seen since the autumn of 2022 is the price of gold rally by 20 to 25%. So it's a big rally. So there'll be people out there who understandably are interested. So firstly, why has gold rallied so much? Part of that is down to interest rate expectations and monetary policy. So if interest rates are going up, it tends to be bad for gold. And that's because gold doesn't really yield anything. It's just a lump of metal, and it tends to trade based on people's fear of the unknown or uncertainty of some kind. So it could be like the debt ceiling is something I mentioned last week. Gold has done well in the environment at the moment because people buy it as a haven asset. So gold has rallied quite well because people are starting to think, well, maybe there is a recession on the cards, maybe in the US, other places. So the price of gold has gone up, and it is another asset to diversify a portfolio. I'll come on to the amounts to have in a portfolio based on research that I've carried out on 80/20 Investor in the past, which I'm updating actually, which is showing some interesting trends. So people can invest in gold in multiple ways. It could be coins, it could be bullion, so they actually own gold directly. But the most likely way that people would invest in gold is through ETFs, so exchange traded funds or versions of them. You get things called ETCs. And you don't need to get bogged down into the difference between those, but it means you can invest in the price of an ounce of gold. So as the gold price goes up, you can therefore benefit from that. The other thing you can do is you can invest in unit trusts out there that invest in gold as one of the things they invest in. So you'll see a fund, it might be a gold fund of sorts, but what they also do is they invest mainly in mining companies, so gold mining companies. Now you've got to think that adds another layer of volatility to what is already a very volatile asset. So gold's price, if you go and look at the price of gold, if you've got an iPhone and you open the stock market app and you type in GC equals F, that's the code, you can see what the latest price of gold is. And you can see that it goes up and down. In fact, when you look at it, it just looks like a share price in terms of that volatility, those ups and downs. If you invest in a fund that invests in mining companies, it adds another layer on top of that, because don't forget, you're not just investing in ultimately having exposure to the price of gold, but also the viability of the mining company itself. Now, when the price of gold is going up, it can be obviously good news for mining companies because their costs tend to be fairly fixed and therefore they'll make more profit, so that will amplify your returns. That's the theory. But of course, you can see that in the other case, you could see a lot of volatility because if the price goes down, they make less profit if their costs have gone up because they've overinvested at a point in time. So be aware that if you buy a fund, particularly unit trust, and it has gold in the name, look to see what it's investing in, because you'll probably find most of it's going into mining companies, so gold mining companies, which increases the volatility on an already volatile asset. So that part out of the way. If you are going to invest in an ETF, it's likely you're going to end up investing in one that is going to give you exposure to the physical assets. So the ETF holds the asset itself. There are different versions which give you exposure via different types of financial instruments. They don't actually own gold physically. They end up having exposure via these financial instruments, which again gives another risk, because obviously those financial instruments, the way they're made, they could effectively blow up. So I won't dwell on that, but that's something to bear in mind. So in my 80/20 investor portfolio, I do invest in gold. I hold a certain amount via an ETF that invests in physical gold. So people often say that gold is a hedge against inflation. I'm not going to dwell too much on that, but it's safe to say that that doesn't tend to hold true. But what gold is a good diversifier in a portfolio. And holding a small amount of gold tends to reduce the volatility of a portfolio. Now, I crunched a load of numbers back in 2015 looking at the impact of holding different amounts of gold in a portfolio. And I had a typical portfolio split between bonds and equities. You can see the research if you sign up to a free trial of 80/20 Investor, and I'm just about to update that as well. And the research at the time showed what would happen if you held, say, 5% of your portfolio in gold, 10%, 15%, and the rest of the assets in your portfolio were split between bonds and equities. So we were keeping a base portfolio, but seeing what would happen if you added gold to it. And what it showed is that holding a small amount of gold does reduce the volatility of your portfolio, but it's not a hedge against volatility, because the more you hold, the more gold you have in a portfolio, actually starts to increase that volatility. And interestingly, if you look at a portfolio, so let's say you just held 100% gold, that over the last 10 years would have produced a more volatile portfolio than if you'd invested in 100% equities. So it is more volatile. Over the last 10 years, that just shows you that it's not a hedge against volatility. But what it does, if you go back and look at, say, last year was a good example, 2022, when equities and bonds struggled, or when you go back to the pandemic, 2020, the price of gold can move in a different way. It's uncorrelated generally to bonds and equities. And so even though it's a volatile asset in itself, if it's doing something that's very different to the rest of the things in your portfolio, it can bring down your overall volatility. Because you think about it, if equities and bonds are tumbling, but gold is going up in the opposite direction, they can start to counter each other. So the gold can start to provide some uplift to your portfolio, which reduces that volatility. And what we found back then was that if you held more than 5% of your portfolio in gold, it starts to increase the frequency of your losses. But having more than 5% of gold in your portfolio also started to increase the volatility of your portfolio. So it started to suggest that around about 5%, maybe to 10% would be the sweet spot to have that in your portfolio, and it works differently. Now, what is interesting, when I performed that piece of research back in 2015, recent history always influences the outcome of any research that you do. And you have to be mindful of that. And so a lot's happened since 2015. Two examples, the pandemic, and we had obviously the Ukraine war and the spike in inflation. And we've seen some incredible market movements. Last year, bonds had their worst year in basically 100 years. Equities had a terrible time. And so gold really did come to the fore different points. It wasn't always going up throughout the year, but at different times of the year in 2022 and during the pandemic, it did become a good diversifier and provide some positives to a portfolio of, say, bonds and equities that would have been tumbling. And so I updated that research, and it's interesting to see what came out the other side, because this time what I did is go, well, okay, why don't you just increase the cash exposure in your portfolio rather than put the money in gold? And what you find is that if you're looking for a portfolio that has the lowest volatility, of course, if you start moving more and more into cash, then the volatility will start to go down. But what happens is obviously your returns start to get hit. But I looked at a portfolio that had all sorts of exposures. That looked at 5% gold exposure, 10% gold exposure, 15% gold exposure, repeating what I'd done in 2015 in the research, but also said what would have happened if instead of gold we just used cash. What's really interesting is that if you held a 10% gold in your portfolio, it had one of the lowest volatility measures for a portfolio than if you'd held large sums of cash. Let's just take 10% gold versus 10% cash. The 10% gold portfolio was less volatile than a portfolio that had 10% cash weighting. And so that showed you that it was a better diversifier in terms of volatility than cash. So gold was the winner there. But what is interesting is that if you looked at the returns, obviously the portfolio with gold in it did significantly outperform the one that had just cash. It didn't have any gold in it. So the message is that gold is a good diversifier, but in fact it was a better diversifier than what we probably realised, because when I did the research last time, there weren't any tough periods, extreme market conditions in the years before 2015, not in recent history, but in the interim we've had two massive market movements, and therefore a portfolio of exposure to gold, you've really seen the benefit of that. So the message from this part of the podcast is that yes, putting cash in your portfolio, it will reduce volatility when you start having large cash holdings, 20-30%, but if you have anything around 10% cash, actually gold does a better job of reducing volatility. And in recent years, it's actually helped boost returns. Of course, you could have periods where gold has done poorly. Now, 80/20 investor members will be able to see the full research and look at what the sweet spots are in terms of gold exposure. But it does seem to confirm that heading towards about the 10% exposure to gold has a merit when it comes to investing and diversifying in recent history. I have about 5%, so between 5 and 10% still seems to be a good level for gold. More than that, you do start to increase volatility. So it just shows you gold does have its place. It's not a hedge against inflation. It's not a hedge against volatility, but it is a good diversifier in a portfolio. Now, people out there who may be already invested in gold, or they might be interested, might be sitting there thinking, well, if gold has actually hit a multi-year high recently, what is the prospect for it going forward. Now, obviously, I don't know what's going to happen to investment markets, but we do technical analysis as part of 80/20 Investor, and I've just done a new piece on that for gold and silver. I'm not going to cover silver. That's the other precious metal that we look at. I'm going to just talk about gold on this. Now, what is interesting is there is a phenomenon in technical analysis called a cup and handle. I'll put a image on the article on the website that relates to this particular episode. And what you've got to imagine is if you go back to 2011, that the market for gold, the price was up around about 1800, 1900, and then it fell away. But as time passed, you imagine it forms a bowl shape. So it starts to pick back up as we get into like 2018, 2019. So it's fallen, but it's made a nice curve. And then it gets back to roughly where it was before when we're looking at about 2020. And that's obviously around about the pandemic. And that bowl shape is what you call the cup. So imagine like a cup of tea. And then the pullback that we had at that point then started to unwind, and we started to get a rally again in the back end of last year. And you can imagine it starts to form a handle. So it's like two semicircles side by side, one big deep one, that's the main cup, and a much, much smaller one, which is the handle. That cup and handle formation, technical analysis, is actually normally a bullish indicator. So if it does formulate and actually complete, it might suggest that there's actually positive news for gold ahead. Now, of course, these things can just unwind and it can negate the whole pattern, but it is interesting to see these patterns play out over a long period of time. And when I did the analysis about 2 years ago for 80/20 Investor, I pointed out that there was a good chance we could see a significant pullback because of this pattern. We completed the first stage of that bowl. Could we now, when the handle starts to be formed, see a significant pullback? And we did. So it's an interesting phenomenon. I'm always intrigued by technical analysis. The point is that gold has had a good run. Does it mean it's over? No, not necessarily. There could be signs that we could see more upside, but of course, who knows what will happen. I do for 80/20 Investor, where I hold it for the long term. It's just a diversifier, and in periods like we've had recently and like we saw in 2022 and 2020, it can be a part of your portfolio that can provide some positive returns when markets get spooked. So in conclusion, for this part of the show, gold is a good diversifier. It can help reduce volatility in a portfolio. Too much of it will do the complete opposite. If you do invest, do look at alternative asset classes because they can have benefits, as I've shown, and don't just focus on bonds and equities, because if you do and you get a year like 2022, then the lack of diversification can end up hurting you.
Okay, so let's move on to the next piece of the podcast then, interest-only mortgages.
So this piece was born out of emails that I'd received at Money to the Masses about interest-only mortgages and what happens when you reach the end of an interest-only mortgage and you don't have the ability to repay it. So normally what would happen is, or the idea is that when you have an interest-only mortgage, you would have a means of paying that lump sum at the end. So with an interest-only mortgage, you are only paying the interest, as the name suggests, on the loan, but at the end of the term you are expected to repay that lump sum. And how you do that is normally you would have some kind of investment vehicle or savings that you can then use to pay the mortgage, and then you'd be mortgage free. But of course there are now a lot of people who have been on interest only mortgages from probably going back as far as the financial crisis, because they aren't that prevalent now. So most people will be on a repayment mortgage. If you've remortgaged in the last decade, you will almost certainly be on a repayment mortgage, which means you're paying the capital and interest. But there will be people who have stayed on an interest-only mortgage for that period of time, enjoying those low rates and not paying much on their mortgage each month. But now there are people, and I think the last estimates I saw, there are about 1 million people this might impact, who are facing the daunting prospect of not being able to repay that lump sum. So Harvey's going to come onto the show and explain what your options are. Now, the obvious first option is that you downsize. So you sell your house and then you pay off the outstanding balance on the mortgage. But of course, if you downsize, you are still going to have to pay legal fees, stamp duty if you buy another place, and you are going to have to probably buy a smaller property unless you move somewhere where you can get more for your money. So the reality is that a lot of people don't want to do that. They're quite happy living where they are. So if you think about the kind of people this might impact, it's going to be people who probably are now in their 50s or something like that. That's the normal sort of bracket for these people because they've had interest-only mortgages for a long period of time. So Harvey, welcome to the show. You're going to run through some of the options. You've written an article on the Money to Masses website, so everything Harvey talks about, if you want more information, you can find out. We'll put links to that article in the show notes. So Harvey, welcome to the show.
Thanks for having me, Damien.
You're a real regular now. You seem to be on the show almost weekly. It just goes to prove that mortgages seem to be the biggest topic of anybody at the moment in finance. Whenever I go anywhere, people are asking about mortgages, their options, interest rates. So, Harvey, I've set the scene of the problem that we've got. And aside from having an investment vehicle, savings to pay off the mortgage, you downsizing, maybe you might have inheritance. What are the options for people who find themselves in this situation where they're probably having sleepless nights about how they're going to repay this mortgage that they've got outstanding?
So first things first is that, your lender is your best friend. You should really start talking to your lender as soon as you realise that this is a problem or may become a problem for you, because opening up that dialogue means that you start exploring all of the obvious options. And if those options aren't available to you, then you start going to the second rung of options and start looking at those options as a means to solving the problem that you're going to have. Like you described, Damien, if you're in a home that you don't wish to sell and move out of, or you can't downsize like you'd planned to because house prices perhaps haven't moved in the way that you expected them to, then you've got to look at other solutions to this problem. And those other solutions basically revolve around mortgage products that are designed for people who are in later life.
So what are some of the options out there for people?
So people generally start, Damien, by exploring what they can and can't do with their existing mortgage. So some people may look to extend the term. You may want to change your mortgage from an interest-only mortgage over to a repayment mortgage. You can do that in full, but you can also do that partially. So some of it remains interest-only whilst the rest of it becomes repayment, so that you are reducing down your loan over a period of time. For some people, you may want to overpay your mortgage now because you can see this problem coming ahead of you. And in those circumstances, you've really got to be aware of early repayment charges that might sort of negate the benefits of doing that sort of thing. So this is why we say speak to your lender and explore these options. Extending the term will be very dependent on what age you are now, because most lenders want you to have concluded your mortgage by the time you're 75. So a standard mortgage won't usually run beyond the age of 75 for when it ends. Switching to repayment tends to be the option that lenders like, because they can see that you're paying down your mortgage and that that's reducing, and you've made a commitment to pay that each month, and eventually the mortgage will be paid off. Or perhaps if you've done it partially, that there'll be a proportion of that mortgage left over that may be manageable in terms of the savings and investment vehicles that you've got running alongside your mortgage in order to repay that. But if you're already at the point where your mortgage has to be repaid or it's imminent, then your options shrink because you're probably older in age. So extending terms and switching to different types of mortgages becomes less doable, largely because affordability tests mean that your retirement income could impede you using some of those measures to solve your problem. So then we move on to products like the later life equity release products that we can talk about.
So before we move on to that, you've covered a couple of really interesting points there. So I know anecdotally of scenarios where people are in their, say, mid-50s, and their current lender obviously wants to have the money paid back, and they've actually gone beyond the term of their interest only, and they're actually in almost crisis talks with the lender. So on the day that you reach the end, the lender will want to talk to you. They're not going to suddenly come knocking on your door, but they are going to want a solution to the problem. So you're going to have to talk to them. It could take a period of time for the solution to be found. But interestingly, you mentioned about the age which the mortgage could go to. Some lenders won't go as far as 75, so you might be looking at something much shorter, like a traditional retirement age of about in the mid-60s, because when you go longer term into retirement, you'll need to have some kind of evidence of the income you'll be producing at that point. So if you haven't got a pension, for example, that is going to be able to pay an income, then you'll find that more difficult. But I just want to give an example anecdotally where the lender would have wanted them to go into a repayment mortgage. That wasn't able to happen in the end because they'd left the problem, and interest rates had been rising so rapidly that had they talked to the lender sooner rather than later, they probably might have passed the affordability test, because what ended up happening is the affordability testing, they failed that because the size of their monthly repayments would have been very high and they didn't have enough income, according to the lender, to pass those tests. So don't put these things off. The sooner you talk to the lender, the better. But in that scenario, the lender did want to come to a solution. So you mentioned one there. They couldn't go on to the full repayment in a very short period of time that was less than 10 years, that would take them up until their retirement age. But the lender came up with a mixture of a repayment mortgage, as you said, and an interest-only mortgage. So a much smaller interest-only part and a larger repayment mortgage. And what that meant is that therefore it brought down the monthly repayments to the lender, and therefore they pass the affordability checks, but they still have a problem in, say, 9-10 years time when the interest only part, the smaller mortgage, comes to its natural conclusion. They will have to therefore have this all again, and they may end up having to sell their house anyway. So what I'm just highlighting is that if you speak to your lender, they will come up with potential solutions. And in that case, they've reduced the problem and have kicked the can slightly down the road. But lenders are facing a lot of people in this scenario, and so they are going to want to work with you. So moving on from that then, Harvey, we're looking at the other products that you mentioned out there that could potentially help people. As I say, there is more information on the Money to Masses website. You can go to the article that Harvey's written. So some of the other potential solutions that are out there, what are they, Harvey?
Yeah, so definitely, I mean, if you've explored all those options, you end up in a situation where you can't do any of those things to solve the problem, and the lender still needs to be repaid, although they might be talking to you and working with you. You may go down the route of later life lending. Later life lending is just a sort of catch-all term that describes a number of mortgage products in the market that help people that are older in age, who maybe are partially or fully on a pension income and perhaps will struggle to pass those affordability tests that you described there. So equity release products allow you to take some of the value from your home without selling your home and moving out of it, and use that to repay your loan. And for people that don't want to move or can't move because they can't find anything of good value that allows them to release enough equity to solve their problem, will find that these kinds of products give them the ability to do that. You've got two types of equity release mortgage products in the market. One's called a home reversion plan and the other one's called a lifetime mortgage. And a lifetime mortgage is generally the option that is discussed when we're solving this type of problem, because the lifetime mortgage allows you to take out the equity to repay your lender on your existing mortgage, but what you end up with is a new mortgage of sorts that doesn't have an end date to it and will run for the rest of your life.
So just summarise that, because I think a lot of people don't understand equity release products. They think, I've got a house that's worth a large amount of money, I've got a lot of equity in it, I can release all of that using one of these products. But the reality is you can't. So there are set percentages based on your circumstances that you can release from your property. So let's say it could be as low as like 25-30% that you can release equity from your property. And also there are restrictions in terms of age as well. You normally have to be age 55 and older. So if you're listening to this and thinking, oh, I'll just release the equity from my house when I get there to repay that interest-only mortgage, there are criteria that you might not have enough money, enough equity to release, and you might not fit the criteria in terms of your age as well. And just on that, I think the real thing to point out is that you haven't solved the problem, you've just kicked it further down the road, because the interest-only mortgage has been repaid, but what you've got is a mortgage now that you're not even paying the interest on. You're not even doing that. It's actually worse than what you had before, but it's now the problem of almost somebody else. If you think about it, that loan is just growing over time. It would be growing at a rate that's based upon that interest and how long you live. In theory, in extreme cases, that loan will just eat up the value of your home, because when you move or you die, the house will be sold and they have to repay that loan. And in theory, the loan could be such a size that you've eaten up all of the equity in that. And one thing to point out, you can't have negative equity, basically. The loan can't exceed the value of the property. But in theory, therefore, you could actually end up having no equity to pass on to your family if that's what you're worried about. So they are a product that has a place, but it is one of those things you have to take advice and see if it's actually worth it, because you're not really solving the problem. You're kicking it down the road, and normally it's an issue for your dependents who will get less inheritance if you're bothered about that sort of thing. So you mentioned home reversion. They work slightly differently, don't they?
They're slightly different. They have different parameters in terms of how much money you can take out of your home, but largely they may not be as attractive to people in this situation because you may get poorer value for money, so you may have to give over a larger percentage of the equity in your home to receive a smaller amount of money, which makes them slightly poorer value. So again, it's worth talking to an equity release specialist who will talk you through how the numbers work on a home reversion plan versus a lifetime plan. But as far as we've looked at, the home reversion plan seems to give you less value for money, but could meet the requirements of some people in the situation.
So in that example then, Harv, we could have a situation. Let's say you had a house that was worth £250,000 and you released, let's say, £50,000 equity from that home. What they would do is they might only give you £20,000 for that stake in your house. They massively undervalue your property at the current value, but you've given away 20% of your house. Then when your house is sold or you die in the future and it's sold, 20% of that property price goes to the lender of the home reversion plan, which means that you've effectively, that property value could have doubled. So they could end up getting £100,000 from your house, but they only ever gave you 20,000 or something like at the beginning. So I've made up the numbers there. It's based on personal circumstances. I suppose I had to mention one piece. There is an option for people who have large pension pots, if they take their lump sum, to use that for repaying their mortgage. But of course, that then has a big impact on your retirement income. So that's why you need to seek advice. There are one or two other products, aren't there, that people might be looking at in this situation?
Yeah, I mean, out of all of the later life lending options that we looked at, the most favourable option seemed to be the retirement interest-only mortgage, which in essence is really having an interest-only mortgage, much the same as what you would have had up until this date when it's ended, which carries on for the rest of your life. But you do carry on paying interest. So when you compare it with the lifetime mortgage doesn't require you to make any kind of regular payments towards it. But you've got to bear in mind that the interest is still accruing on that loan and it's perhaps compounding so that it's repaid at the end. But in this instance, what you're doing is you're paying the interest on your mortgage. So you release the equity, you pay your original lender off. You've now got this new mortgage with no end date, you're paying the interest on it, and when you die or move into long-term care, one of those two things would need to happen in order for you to repay the loan. Then it's just the original loan amount that is repaid from your home. And that might be slightly more palatable for people, purely from the point of view that your dependents and those people that are inheriting the property may look at the property and think, well, it's increased in value, so there's still something to be had or to be left behind in inheritance. And the interest that was paid has stopped that interest compounding over the period of time that the individual with the house has survived.
So these products, I'm guessing obviously with the retirement interest-only mortgage, there's affordability checks that are going on because you are going to need to be able to afford those interest-only payments. Generally speaking, the rates you're getting on these products, they're not going to be market leading.
No. I mean, essentially, you're looking at something that is a specialist product. And when you're looking at a specialist product, you're not going to get the most favourable rates. So you will probably be paying interest rates that are higher than what you're used to paying on your mortgage as it stands at the moment. But they are helping you out of a problem. I mean, if we think about remaining in that situation where your lender's looking for the money that they've lent you at the end of the term and you can't pay it, not repaying your interest-only mortgage loan at the end of the term could affect your credit score. It could stay on your credit report for up to 7 years. So it's something that you want to deal with ahead of it happening because it's not an ideal situation to be in, especially if you're moving into retirement and your income is shrinking.
So I hope that people take the positives out of this situation, because I know there are a lot of people out there who are in this predicament who are probably having sleepless nights about what they're going to do. So just to give people the options, the hope, The main thing is you need to go and engage with your lender. You need to deal with this sooner rather than later. And the other thing I just want to mention, I'm obviously a big fan about flexibility, and you've got to realise that when you make a decision, that it does have implications on the future. So let's say, for example, you don't decide to downsize and use one of these other products, then it can mean that you have less equity in your home if you did decide to want to move at a later date somewhere else. So when you make a decision with these products, it can therefore reduce your options later on. So it is one of those things you've got to bear in mind when you're seeking advice. So hopefully that would be pointed out to you. So Harvey, thank you for coming on the show. I think that was incredibly useful. As I've mentioned already, there is an article on the Money to the Masses website where you can find more information about this and about equity release, and we've put a link in the show notes of this episode. Actually, I've just had a thought before we move on to the next piece, Andy. Just throw out there for completeness, there is a product called a retirement repayment mortgage. Now, you don't really get many of them. If you look around, you won't find much information about them. They will be difficult to get, and as far as I can tell, there are only a couple of lenders out there that do provide that as an option, which is why we've not covered it at all in this part of the podcast. So for the final piece of the podcast this week, we're going to do a piece on energy, and in particular regarding the energy price cap.
Yeah, that's right. So Ofgem have announced the latest figures for the energy price cap that are set to come in place on the 1st of July 2023. The current figures for the energy price cap is a figure of £3,280. Just to explain what that means, that is the average bill for a dual fuel household in the UK. That's what an average family would spend on energy. That was capped at £3,280. The new figures, however, mean that it's been reduced to £2,074. So that's quite a big reduction, but it's not as simple as that, because we need to explain something called the energy price guarantee. Now, the energy price guarantee, stay with me, Damien, this is something that we've been used to over the winter. It is a cap that the government have put in place. Effectively, it's a subsidy that the government provide us to ensure that we can afford our energy bills over the winter. So what the government said was £3,280, even though that's the price that Ofgem sets, that's way too expensive for most households. We won't allow UK households to pay up to that amount because it's too much. So what we'll do is we'll add an extra layer of protection and cap it at £2,500, effectively meaning we don't pay beyond that. Of course, we all received additional £66 a month. Do you remember that? We've covered it in the podcast before. And again, that helped us through the winter months. So we've been used to being helped out. Now, I mentioned the figure of the 1st of July a little bit earlier. That is the date that the new energy price cap comes into force. Now, that's a key date because the 1st of July is also the date that the energy price guarantee, the subsidy from the government, is going to go up. Now, it's going to go up from £2,500 to £3,000. So it's going up by £500. So if we do these numbers again, we were previously on an energy price cap of £3,280. We never paid that because the government put the subsidy in at £2,500, effectively capping it. Well, from the 1st of July, that subsidy from the government is going up, but the energy price cap is coming down. So suddenly we're going to be in a position, come the 1st of July, where our energy bills are actually going to be capped as per the price set by Ofgem.
So that means that, to keep it simple, where we were previously, average bills were for a household dual fuel would be £2,500 capped. It's obviously capped at a unit rate, not the 2,500 number for a household, but the unit rate. We were also getting the £60 a month as well. Now they're basically disappearing. So now we're going to end up on this new energy price cap. It's likely going to be dictating our energy bills. So what does that mean then if somebody was thinking, okay, I know how much I paid a month for my energy during the winter of 2022 into 2023, what's that going to look like going forward? How are my energy bills going to compare maybe now during the summer or the winter compared to this one that's just gone?
Okay, so let's make it really, really simple. What we've done is we've crunched through the numbers, and if we ignore the energy price guarantee, the government subsidies, the extra £66 a month, how much that people are paying now, how much less will they be paying come the 1st of July? Well, the simple answer is it's 17% less than they're currently used to paying right now. So for every £100, let's say, you're going to be paying £83 per month going forward for your energy. So if you were used to paying, let's say, a direct debit of £150 a month, I'd use that figure because that's actually similar to what I pay, then it's a £25 a month saving on that 150.
So that keeps it nice and simple, Andy. Taking your example, if you were paying £150 a month dual fuel during the winter that's just gone, that's what you're paying roughly now, then based on the changes in pricing, because of that energy price cap, then you're saying they'll probably pay £25 a month less.
That's right. The energy is going to cost £25 a month less. Ignore the £60 extra payments we were getting. They're £25 a month better off for that energy.
Yeah, but of course now they aren't going to get the £60. They'll actually feel now that they are £35 worse off a month than they were before. So that just shows you how all this dynamic is a bit confusing, but I think you've kept it nice and simple. Going forward then, we always talk about Cornwall Insight whenever we talk about energy prices, because they are the consultancy that predicts where the energy price cap will be in the future, and they are very accurate with their predictions. Presumably they've updated their predictions. Now we know what the energy price cap is going to be in July. What are they saying now about future energy prices?
Yeah, so as you say, Cornwall Insight are pretty accurate. To give you an example of how accurate they were predicting that the energy price cap would come down to about 2054. Well, it came down to 2074, so only £20 out. So we could pretty reliably say that energy prices, so long as nothing major happens in the energy market, in the coming months, according to Cornwall Insight, are going to come down to, in October, they say, about 1,959. And then come January 2024, it's going to be roughly 2,026 annual dual fuel averages. So pretty similar to what we're going to be experiencing from July. So hopefully stabilising a little bit.
So Andy has actually encapsulated all of that in a brilliant image that is on the Money to the Masses website. We'll put a link in the show notes to an article on the website for this show this week. But it does highlight that really the energy price cap is going to be around £2,000, likely predicted to be by the end of the year. That is a 20% discount to what we were all paying in the winter of 2022. But the reason you won't feel that much better off is because we're not getting that £60 a month that we were getting. So that just briefly summarises the situation, that bills will be 20% cheaper, but you won't necessarily feel that much better off.
Yeah, and if you pay for your energy by direct debit, of course, if you keep that direct debit the same, then with lower usage, you could see that you start to build up a little bit of credit maybe, and you've got less panic coming into this winter, assuming that Cornwall Insight's predictions are correct.
So you make a good point there, Andy, that obviously going through the summer with lower energy usage, you are likely to build up some credit if the energy prices keep falling. But do be mindful of that balance as well, because obviously that is technically your money. You don't have to leave it with the energy company. Yeah,
it's a really good point. So that is it. We are done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's Damien@moneytothemasses.com. You can get in touch with me if you like. It's Andy@moneytothemasses.com. We have got the Facebook group. Do check that out, because if you've got any ideas for the podcast or feedback, it's a great place to do it. It's facebook.com/groups/Money to the Masses. And Damien, we're doing a lot on YouTube at the moment. We'd really love people to go over there and subscribe to us. Even if YouTube isn't really your thing, if you could go over there and subscribe to our channel, it really helps our numbers and the algorithms and everything else.
Yeah, and we're going to be doing more on YouTube. So there are going to be things that are going to be on YouTube that won't be appearing elsewhere. We are starting to film the podcast, so you'll see bits of these shows on there. You can see me and Andy doing this visually, but also there will be other content that we're planning on releasing that will be unique to the YouTube channel. So it's definitely worth going and checking that out. As ever, Andy, we have left it to the end to mention to people about leaving a review, which is a real shame. We should do it more often. We had a nice couple of reviews this week that I will read out on a future episode, so please do leave a review and you might get yours read out and you might win a Money to the Masses mug.
Brilliant. So that's it. We're done for this week. Until next time.
Until next time.